bit slow. Hello, everyone. Thanks so much for joining this webinar between Edition Finance and BizVal. I'm Graham Davies from Edition, and we're very, very happy to be joined again by BizVal, valuation specialist, as the final part in our three-part series, which is fantastic. So this topic is a case study. This webinar is a case study. It's around from fair value to explosive growth, how I exploded online retail growth. And it's a real life case study about a client of BizVal, and we'll get into that in just a second. Your hosts are, as I said, Graham Davies from Edition Finance, and another Graham, which always makes it confusing but fun, Graham Stephen, a CEO from BizVal. So the way this is going to work is it's going to be very informative. We're going to be having a conversation about this case study. We've got some content to share with you, but please do jump in with any questions as we go through the content, the material, and if it's relevant at the time, then we'll pick that question up as we go and make it very conversational. And if not, we'll pick it up at the end to make sure we cover off any questions from you guys. But thanks again for joining, and really excited to get the insights from Graham and BizVal. Really quick introduction from me. I've raised lots of money for companies big and small across my career in senior finance roles, supported multiple businesses through to exit from purchase as well. So I've been involved in the whole cycle, and currently the founder and CEO of Edition Finance, which is a high growth business, and always interested to hear about valuations and everything related to that. So looking forward to this. I'll hand over to you, Graham, now.
Great, thanks, Graham. Yeah, always wonderful to be here and get my the tongue twister with the G's going, because the two Grahams. But yeah, I think just briefly, my background is the founder of BizVal. In essence, we're passionate about empowering entrepreneurs to better understand the value of their business. For most entrepreneurs, this is one of their single biggest assets that they're building potentially, but also one of the single biggest misunderstood piece of value that they're building. There's often an assumption that I'll build a business and I'll sell it one day, not knowing what it takes to actually enable that. And creating value is not necessarily about selling a business. It's about understanding what the value drivers of your business are, how you can unlock those over time and give you choices and optionality. So we love being here today. Wonderful just to share stories, and we love to engage in a practical way that can relate to business owners and founders. So you're not going to hear a lot about fancy technical valuation terminology. It's about real stories and real founders. So Graham, thanks for having us here again, and looking forward to the session.
Thanks, Graham. Yeah, real pleasure. So I'll just quickly go over the agenda, and then we can get straight into the case study. So we'll just quickly talk about the overview. We'll talk about the background to the buyer. So this is a company who's acquiring the company we're talking about, how they went about identifying what sort of company they should buy, the planning and the scenario planning they kind of went through, the process they went through before acquiring, how they then executed that plan, and what the results were. Then at the very end, we'll just do a quick summary of the key takeaways. But yeah, I think I'm really excited to get into this now, Graham. So why don't we go ahead and go straight into the case study overview?
Fantastic. So I'll kind of start with the end in mind and give a brief summary of what you're going to hear about today. But in a nutshell, this was a real client of ours. They operated 3 existing online jewelry businesses across 3 countries. So they were operating in United Kingdom, in South Africa, which was actually where they originated or started the business, and in Australia. And essentially, they were looking to expand their presence in the United Kingdom. So they had an operation there, but it was a fairly small operation. And they had to decide, were they going to invest heavily in building that brand in the UK, or were they going to acquire an existing brand that they could then go and actually grow? And they decided to acquire an existing business that was similar to what they were doing, but had sort of specific criteria. So what they did is they went in a targeted search, identified exactly what kind of business they could plug into. So let's call it a strategic acquisition. They did a thorough but quick evaluation and scenario analysis. So they actually looked at a bunch of different businesses. It was very important for them to understand what they were paying, but also what they could unlock in that business. So at a micro level, this is what private equity players and that do. They look for businesses that they can roll up and pull together and create additional value. So to say this was an entrepreneur like Graham or myself running an SMB business and looking to expand. So it's not the world of high finance, but a lot of those principles applied. I think the other thing to talk about here is because of the process they followed, they could close the deal quickly. One of the things we talk about in buying and selling of businesses is something called deal fatigue. Because they did their research well, they were very clear. They could close the deal quickly. And we'll talk about that later. And that allowed for trust to be built between buyer and seller and none of the sort of deal fatigue that can so often happen. And most importantly, the integration plan was followed by quick execution of that plan. So they had a plan and they executed it. And often deals, most mergers and acquisition deals don't result in an increase in value. I know that's counterintuitive because it comes down to the execution of those plans. So having a clear sense of what's achievable, how you're going to achieve that, and a practical plan that you can execute is absolutely essential. And in this case, the business within an 18-month period from the acquisition taking place had a 4.5 times increase in value and a 2.5 times increase in sales. So you can see by the ratio of those numbers that the value increased proportionately more than the sales did. So we're going to dive a bit in today and kind of how they went about it, what the process was, and how they actually achieved this.
Great. Looking forward to that, Graham. That's fascinating, that point you mentioned actually about most acquisitions don't actually deliver a return, which is interesting to hear about. Maybe that's a separate topic we can talk about, how to make sure you do actually get a return. In this case, they did, which is fantastic. They got a really strong return. And I think my experience of that would probably be that people get quite emotional about acquisition and they often overpay. So it's actually really important to stick behind the metrics and pay fair value. Hard number to land on.
That's a great point. Emotional purchases tend to be very expensive purchases in the long term.
Yeah, absolutely.
Cool. So I think we gave a bit of background. So just for context, who was the buyer? As I said earlier, it was an online jewelry business operating in 3 countries. Size-wise, they were doing about £2 million a year in annual turnover, and they were making £400,000 a year in profit before tax. Okay. These businesses had all been developed from scratch. So, from opening up the record and company's house, from zero, basically. They'd been in operation for about 8 years, in South Africa for 8 years, in Australia for about 5, and their UK operation had been running for about a year. So, it had been in existence for a while. What they had done is all their manufacturing and assembly had been centralized in South Africa. We actually spoke about this on a webinar, I think way back. It was a BizVal webinar when you joined us, Graham. And the benefit with this was, they had some manufacturing cost efficiencies, and they were able to leverage that strategically. They also had strong expertise. We're talking to a lot of high growth digital businesses around search engine optimization, PPC or paid ads. And they had good internal CRM and email marketing capabilities. And they also had strong buyer relationships with, raw material providers and jewelry providers. So this was kind of the backbone of the existing business. Last 2 things, a great understanding of unit economics. So they knew their costs backwards. And Graham, you might want to jump in here. They had a great accounting team, and they tracked these things. So they knew exactly to the cent what each ring cost them or what each, bracelet cost them. And they were heavily focused on customer service. So their reviews were 4.9 on Trustpilot, on Google. And the existing business in the UK, as I mentioned, it was profitable, but it was subscale. They felt that there was a big opportunity and they wanted to leverage. So I don't know if you want to just jump in there on
Yeah.
those accounting piece, Graham, but I think I make this point time and time again. It is so
Well,
critical, even if
yeah,
you're a small
absolutely.
business.
Absolutely. And the thing I would say about all of these things really is, apart from the time element, the manufacturing and assembly in South Africa, the strong expertise in general marketing and SEO and everything else, and the effectiveness of that, understanding of unit economics, all of that is only actually possible if you have really good financial management in place, bookkeeping, accounting, the basics really. So we often talk about companies that if you're looking to buy, if you're looking to sell your business, make sure or raise money, make sure you're investor ready, get all your numbers in order. But also if you're buying, to really understand the value that you might be able to bring to an acquisition. And we talk about synergies, which is a term maybe people have heard. You'll probably hear it a lot if you explore this. To really land on the synergies of buying a company, you really need to understand your own business in depth. So it's really key, whether you're buying or selling, to have a really good understanding of your strengths as a business. And you can only really get that through financial reporting.
Absolutely. Okay, so the next part is equally important. You don't just wake up one day and say, okay, I'm going to go buy a business. Okay, once you've decided you're going to buy a business, and this is something that's often not done very well, is the identification of the ideal target. Okay, so what kind of business do they want to acquire? And they had very specific criteria. They had a target price. They had capital available between 250 and 400,000 pounds target price. They were also looking for an owner managed business. So they were looking for a business that was owner managed, a business that was also potentially subscale but profitable. So there was a profitability requirement there. They insisted on having a good reputation in market, so a Trustpilot score of greater than 4.5. They also wanted to be regionally based. So they wanted a business that was outside of London. Again, salaries, cost of doing business, all of those sorts of things. They didn't want to pay a premium for things that they didn't have to pay a premium for. So the business that they acquired was in the southeast or southwest, sorry. So, again, immediately one of their key criteria. And they also wanted a business that was currently being run as a bit of a lifestyle business. Okay, so they didn't want to go and acquire another business that was ambitious like them to go and grow and scale. Okay, so those were their key criteria. And they then identified, they went to a number of online marketplaces, they went to a number of brokers, and they identified a few targets, but the one they settled on was on an online market platform, and it was on the market for £285,000. It was 3 years old. The owner was in their early 30s. They had started it as a bit of a side hustle, or his wife had started it as a side hustle. They had kids and a family, and it was now, okay, look, it served us well. We built a bit of a business, but this stage of life, we actually would rather offload it, get the capital, and build on the playroom to our house, basically. So that was the business that they had found. And importantly, they were very clear on what they wanted. So Graham, we spoke about this often, is being clear on what you're trying to achieve and what you're trying to acquire is absolutely essential.
And also how awesome is that? Someone created a side hustle and managed to sell it for almost 300K. Great result for them. Eh? So that's good. Who says side hustles don't work? That's brilliant. And I think it just highlights, doesn't it, where the value is for the acquirer. They wanted someone who's running a lifestyle business. They're outside of London. And I guess that was because the costs of running it are lower. The lifestyle business probably means that there's lots of value to extract from the business because they're not running it optimally, with a team of people making everything super efficient and extracting every penny they can. So there's a lot of value to be extracted. So it sounds like a really smart acquisition strategy.
Okay, so then let's talk about what they did next. So they then approached us and they'd identified this target. And the question they had for us is, well, am I paying fair value for this business? So a lot of deals break because people overpay at the beginning. Okay. And what they did is they came to us and said, look, we want to evaluate this business. We'll do a due diligence, we'll do all those good things, but we want to understand, are we paying fair value to start? And then secondly, if we implement our strategy, this is our strategy, what do we think we can achieve with this business? So the business they identified, as I said, it was listed at £285,000. It was turning over £400,000 a year in revenue, and it was making £85,000 profit after tax. Okay, so it was similar sort of ratios to their business, but quite a bit smaller. Growth was slowing, and the reason it was slowing is because the existing founders had kind of reached the limit of their expertise when it came to SEO and digital marketing, but also they didn't have the time anymore. So they had a young family. The side hustle, was replaced by kids' bath times and bedtimes and all those good things. Um, and their marketing initially had been focused on what we call paid marketing. Any of those of you in the online space is we know how difficult that space is becoming. The paid marketing becomes more and more competitive, and your return on cost of acquisition can diminish over time if you're not on top of your game there. So that's what they found about the business. They did an independent valuation with Bizwell. And if you took the current trajectory of the business, how it was growing, they found that fair value was £270,000. So the list price of £285,000 wasn't completely out of kilter. It was a little bit higher, but nothing material. But the kicker is they said, well, actually, fine, we're going to pay fair value. We're not going to try and, you know, shortchange the seller. We're not going to try and say, hey, we'll structure this as a complete earnout. They knew they were paying fair value, but they wanted to understand what the value could be. So they ran a bunch of scenarios. They said, we've got a strategy to take this business to the next level. What they were going to do is they said, we're going to focus on search engine optimization and reducing paid advertising. They had, as I said earlier, they had a very strong internal mail base. So they wanted to plug their direct to consumer communication strategy in via a mail campaign and subscriber list. They were able to pass on the buyer bulk discounts from their existing strong relationships. And they also importantly wanted to migrate all their accounting, CRM, finance and operations onto a common platform. So they were using Pipedrive as their CRM, and they were using a zero-based accounting practice as their back end, which this other team wasn't doing. So essentially, there's some consolidation at an operational level that they could make. And based on this plan that they had, they felt that if they implemented these initiatives, they could build the business value to £500,000 within 2 years. That was their baseline. Increase sales by 25% and basically double the price or the value of the business within 2 years. So as an acquirer, if they did a half decent job, that 270,000 acquisition price could pay for itself fairly quickly. So it gave them the confidence to go in and then negotiate the deal. So Graham, I don't know if you want to jump in there quickly, but I want to move into kind of that part of the negotiation, how they settled on a price and why that was important.
Yeah, sure. No, that makes sense. Yeah, I guess as I said earlier, you can see that they really sort of going big on their sort of synergies, if you like. They looked at the strengths of their own business and they built the upside of those strengths into their scenario planning, into their plan, their target for the acquisition business, which is great. So that's where they saw the value, which is almost like textbook M&A, to be honest. Fantastic.
Yeah, and there was nothing complicated here. It wasn't this like, oh, we think we can. They had a very clear plan.
Yeah.
And there was no certainty at this stage, but I think the simplicity of the plan was really what kind of led to the success, which we'll get to. So let's go into the execution. So how did the deal place? Okay, clearly they were now interested in doing the deal. So they made a deal for an all cash offer of £280,000. As I said earlier, that was 5K less than the asking price, but 10K more than what they believed fair value was. They held back 10% of the price for a 6-month period. That was just for contingencies. Were there any debts or tax liabilities that wasn't picked up in the due diligence process? But it wasn't an earnout. It was just a 10% held back until everything was bedded down. And What they also did is they wanted the existing seller to be motivated. So they added an incentive of 10% of the first year profit. They paid fair price and they said to the seller, listen, we'll give you 10% of the first year profits. We're confident in what we're doing. And they kept, we'll get to that just now, they actually kept on the seller as an advisor for 12 months, not operationally involved in the business, but they had nothing to hide. They wanted him to be bought and invested into the deal. So he's de-risked because he gets his price, but he's also motivated to make sure that he doesn't hand over a lemon because he's going to get 10% of the additional first year profits. So they then didn't make any changes in the business for the first 3 months. And this is really important. They said, we're going to acquire the business and we're not going to come in on day one and make changes. They waited 3 months before they implemented their strategy. And they got to know the existing team. They got to build trust. They simply spent time in the business, getting to know the business. What did they do? They kept the brand the same. And this was important. So the existing business had a brand that they were trading under. But this business in the UK was subscale that they acquired, but it had a good brand, it had a good name in the market. So they didn't want to alienate the market and the business. A lot of businesses go in, they acquire, and suddenly they rebrand, and you lose a lot of goodwill in that way. So this business had client goodwill, so they kept the name the same. They appointed an in-country operations manager. So the previous CEO stepped out as an advisory capacity for a year, but they appointed an operations manager and they paid this person a fair market related salary. They kept all the existing staff, and they did something that wasn't in place before, is they put in specific revenue targets. This had never been there before. And for the existing staff as well, they put in a quarterly incentive for both the new staff and the new operations manager and the team. And they made the in-country manager who they appointed, the operations manager, accountable for those targets. So the staff were super invested now because suddenly they could also, see that there would be an upside for them if they hit the targets. They focused on their SEO strategy. So the first thing they did was they, brought in their SEO capability, and they then optimized their Facebook and their Google ad spend. So they actually reduced the spend on Facebook and Google, and they switched that out for investment in SEO. They drove their repeat customer campaigns through mailing lists to their client base. And they also targeted campaigns to the sister company client base. So as I said earlier, they had an existing business in the UK, and they cross-pollinated those two audiences, which was actually a stroke of genius, I guess, because that gave them an extra benefit, which I'll talk about later. Their bulk purchase agreements that they had in place, and they knew this when they did the acquisition, gave an immediate 10% drop in the input costs. So they were still assembling and everything in the UK, but because of the bulk purchase agreements, they could pass on a margin at the top line straight away. And then the other thing they did, and Graham will probably jump in here, is they implemented a monthly key metrics and finance review. Again, very simple. What are the targets? What are the key things we're driving? And they included the entire team in that discussion. So, Graham, I don't know if you want to chip in there, but I mean, we emphasize this a lot.
Absolutely.
That simple review, focusing on key metrics, is so essential.
For sure. And I think if you are looking to acquire a business, or you have, and certainly my experience of working on these sorts of projects is the sooner you can get your reporting set up, the better. So really try to integrate their systems, their reporting in a way that gives you really good insight from day one, because that's really key to making that business case a success. So you've got your theoretical targets and financial model and sort of reasons why you bought the business. Is really important from day one that you start to realize that value, and we can only do that by having those metrics in place. So it's really basic stuff, like you say, that monthly finance review, but recapping on the targets that you set before you bought the business, and just making sure they're on track is really important, and really actually has an impact on the value of the company, which I think some people don't always tie the two things together. Oh, it's a monthly finance review. Oh, that's actually could be tied to the value of my business, because if I'm always optimizing my metrics, my margin, my marketing, whatever it is, that's having a direct impact on the value of my business and therefore my wealth as an owner manager.
Absolutely. Okay, so let's talk about the results. So that's what they did 18 months later. So this is actually what transpired and what they achieved. So that growth target they had set themselves, they exceeded it. Their annual sales growth is 80% per year, year on year. Okay, so that was the first thing. Top line, they actually managed to increase more than they expected. Their gross profit margin increased from 55% to 60%. Okay, so that was, they didn't change their pricing strategy, but that was effectively the buyer discounts that they were able to pass on, from a cost of sales perspective. So that gave an immediate improvement in margin. They had a 30% improvement in repeat customers. So by leveraging their newsletter and their mailing business, they actually brought that and controlled that rather than having, let's say, Google and the search engines being in control of their customer. They started to leverage that. So 30% improvement in repeat customers. And what they found with repeat customers is repeat customers spend more, they build loyalty, all of those good things, So it wasn't just getting something for an upcoming wedding. It was now buying a piece of jewelry for their daughter's 13th birthday. And that repeat business became really, really important. The operational costs actually increased. So the operational costs were running at about £100,000 a year, and that increased to £150,000 a year. That was a function of two things: having the operations manager in place and the staff bonuses. But there was also an offset because their Google advertising spend reduced quite substantially as well. So they actually invested in an additional sort of £80,000. They saved about £30,000 in terms of AdWords spend, but all in all, their costs actually went up. The annual profit, and this is where the leverage comes in, went from £85,000 profit after tax to £325,000 a year profit after tax. And what this meant essentially is that the business was actually paid for, from the first 18 months of incremental profits. So for the acquirer, they paid for the business within 12 months. Now, what's interesting here is people say, oh, but why didn't they just do an earn-out, whatever? But the beauty about this is because they paid fair value, what the previous owner wanted, they paid for that up front. So he wasn't left feeling, oh, I've been shortchanged or anything along those lines. He was bought in. He got his asking price, essentially. And he got a kicker on top of that. So he got his 280,000 plus an additional 332,000 or 10% of profits as a bonus. So he was delighted. And this was by knowing and understanding what the levers were. If they hadn't achieved the outcome, if sales had been flat and they had gone backwards, well, obviously the buyer would have carried the risk. And the previous seller would have still been happy because he got his asking price in the first place. So this is really important, is the acquirer wasn't greedy. They didn't want to kind of just take it all and transfer all the risk to the seller. I think that's essential. As I said a bit earlier, the real bonus here was the existing UK business that they had also benefited. And the sales in that business also increased by 30% because they took some of the local nuances that they didn't really understand in the existing UK business and started to apply those. So there was a sort of reverse effect back into the existing UK business that also improved. So we're not talking about that impact, but the valuation on the business then went from £280,000 to about £1.3 million over this 18-month period. So that basically increased the valuation 4.5 times in 18 months. So this is not a made-up story. This is a real-life case study. And I think the reason we're sharing this is because I think we want you as business owners to realize these things are possible, but you need to do your homework. You need to understand the drivers. You need to be quite disciplined around these things. And you don't have to be a crook. You don't have to shortchange the seller or the buyer to be able to do that. So, at the end of the day, it's all about trust, knowing your numbers, having a plan that you can execute. So before I wrap up, Graham, and just kind of talk through the key lessons, I don't know if you want to add in anything here before we go through a quick summary.
That's really helpful. It's such a great result. But what I wanted to just add as well, actually, because you mentioned it's not about being a crook, which I think is really an important message there as well, because I think lots of people might think that the way to get a return on your investment if you're acquiring a business is to haggle on the price and to agree a lower price, which of course absolutely helps. But you can see the impact of these initiatives, the impact of improving that gross margin and getting more repeat customers is worth significantly more than just chipping away at the price by 10%. And so what buyers should really be focused on is how can they realize, how can they extract more value from this existing business? And that's a really, really great example. And like you
Yeah, and I
said,
think
go on, Greg, sorry.
there you go.
Like you said, it's about it's the basics, really, isn't it? There is a lot of number crunching here. It's really being thoughtful about what you're acquiring and the characteristics of those companies you're looking to acquire, and then tracking, and making sure you're hitting those targets and optimizing on a regular basis, not an annual basis, not a quarterly basis, but a monthly basis.
Yeah, and I think that you touched on the point around trust is by not shortchanging the seller. They had an ally in the seller. Yes, he was ready to move on, but he felt he could still contribute, and he saw his baby now growing into this as an adolescent, and he was actually quite, he wasn't resentful of the seller of the buyer, getting this extra value. He was actually quite happy about it, and that was about understanding who from a buyer perspective, understanding who the target was and identifying the right kind of business to acquire in the first place was really, really important. If you had acquired a business where the owner was perhaps tired, he was just over it and fallen out of love with the business, he may not have been able to achieve that. So it's all these things coming together.
Absolutely. And actually, the other good point on the other side is, from the seller's point of view, they really wanted to sell it to someone who can bring some value to it as well, because that really helped them then get a cash offer, for example. Whereas if they sold it to perhaps someone in a completely different industry with no synergies, with no way of really extracting more value, perhaps that would have been more about price and earn out and all the rest of it. So actually, there's an element of valuation is absolutely linked to who the buyer is, I guess, rather
Correct,
than
100%.
yeah.
So let's just recap on some of the lessons learned. So I think we go into the next slide. I think there's sort of
Yeah.
8 key things, and we've spoken about them, but just to recap, I think the first thing is, understanding from the buyer perspective the valuation drivers allowed them not to overpay, but it also meant that they weren't haggling unnecessarily because they understood that they were paying fair price. Leading into the next point is the scenario analysis also allowed them to war game the alternate scenarios and act with confidence. So they could come in and say, let's do a deal. It didn't become a haggle. It didn't create the sort of animosity and deal fatigue and all those kind of things. So being empowered and clear and understanding what were they paying and what could they do to improve the value allowed a quick deal to happen and to build trust between the parties. I think the other thing here is, you hear a lot about this, buy a business with no cash down. Okay. But the one thing that an all cash deal does do is it allows the buyer to move quickly and execute the strategy. So, they had a very clear plan that they wanted to execute. If they had have paid 30% upfront with an earn out on the balance, it would have been a lot harder for them to just go and say, we implementing the strategy. Because if the seller didn't buy in it, he might have been saying, well, I'm not going to get my earn out. I'm not going to. So there could have been friction there. But the all cash deal allowed the buyer to basically execute what they knew would be a good strategy. But by giving the sort of upside to the seller, also kept them invested and motivated. So, I think that's important, and that sort of buy-in and the smooth handover with the existing owner is essential. Buying and selling a business is not about just selling and the seller running for the hills often. I mean, we like to think that, but having that sort of relationship, and maybe it sounds naive and all sort of like what's it? I'm trying to think of the right terminology. Kumbaya kind of thing, but it was clear and was based on facts. I think the other thing around, they didn't make changes immediately. So the limited changes that they made initially allowed them to build trust and actually understand the business. Was there something in the due diligence that they missed? They didn't quite understand. So not just, it's like touch, pause, engage, to use a rugby scrum analogy. They paused and they looked and they saw, okay, let's just double check our assumptions before we go making changes. The continuity of the staff and the brand also meant that the existing customers didn't perceive a change in ownership. I mean, that's so important as well, is they had a loyal base, but they weren't growing that. So keeping the brand, keeping the staff invested was important. The buyer clearly understood their strengths and their capabilities. So they were strategic about the acquisition and the acquisition target. So that was absolutely critical. And then the last point, it's not the sort of PS at the bottom, but it's really important, is I think the optimization and alignment of accounting, reporting, and CRM systems was important because it allowed them to kind of understand the acquisition in the context of the broader business and put in place those monthly reporting cycles and KPIs and all those good things. So, very simple case study, but I think we would love to see more of these kind of deals happening, both from a seller and a buyer point of view. And what we're trying to do, I said, is possible. Okay. You don't have to just, believe the horror stories when you acquire and things fall out. And this is, I think, a blueprint on how you can make it happen. There's no certainties of life, but this increases your odds of having a deal that's a lot more successful. So, Graham, I don't know if you want to kind of wrap up from your side before we take maybe one or two questions.
No, I thought that was really insightful, and I suppose it sounds like the perfect acquisition scenario, really, doesn't it? And it would be great if all of them go like that, but they probably all don't, and it's probably the exception. But that's okay. I think the important thing is if you are acquiring a business, really take a lot of the learnings from this around the making sure you optimize and align all the systems and really integrate the business, if you like, so that you can implement that scenario that you planned in a really efficient way. But awesome. And I mean, it's really exciting because I know there's a lot of, you probably hear this a lot as well, Graham, but there's a lot of sort of baby boomer businesses for sale right now because they're getting to an age of retirement and there aren't a lot of buyers, but it shows that in that space, there's a lot of value to be had. And I think it could be a really exciting space over the next few years as lots more companies do a lot more M&A in that space. So looking forward to hopefully much more of these scenarios, case studies.
Absolutely. So, Graham, I don't know if there's a question or two. I mean, I think, if not, that's also okay. But let's see if there's something that's come through. Yeah.
See if there's any questions coming through. We're here for another 7 minutes or so, guys. So if you do have any questions, please do feel free to ping them in the chat there, and we'd love to pick them up. I'm picking up the one initially, which is, the question is, Graham, why did the value of the business increase by 4.5 times if revenue only grew by 2.8 times?
Okay, that's a great question. Okay, now I'm going to use a financial term here. It basically came down to, I mean, what we call operational leverage. Okay, so there were two things that happened. Revenue increased 2.8, it was 2.8 or 2.5 times, I forget. Your gross profit margin, because they got savings on the acquisition, increased from 55% to 60%. Okay, so there's a multiplier effect in terms of your gross profit because of the savings on the margin. The second thing is the costs did not increase 2 point. So the scale between sales and costs. Okay, yes, they invested more. It was an extra 50,000 quid a year in terms of costs, but that was fairly static. There was one additional person that they acquired. So the profitability, okay, sales went from, I forget the numbers, it was 400,000 quid to about 1.2 million. Okay. And the profitability went from 85,000 profit before tax or profit after tax to 325,000. Okay. And I'm simplifying a little bit, but from a valuation perspective, and I know we don't like to talk about multiples, is, your profit is your key driver and your profit growth is your key driver of valuation. The other thing there is that the growth rate of the business jumped significantly. So when they were acquiring the business, this business was growing at sort of 15 to 20% a year. That's where it tapered off to. they were now able to accelerate growth to 80% a year. Now, it wouldn't always be 80% a year, but the overall expectation of growth would be that it would continue at a higher rate than the 15%. So those are the factors. It's increase in the fundamental profitability of the business, but also an increase in the forward growth rate of the business is what drove that sort of Jaws effect on the valuation.
Wonderful. That's great. That makes sense. It's really about the profit multiple, isn't it?
Yeah.
So we have another question from Omar. Is how does valuing a lifestyle business differ from a more corporate business? And this was a lifestyle business.
So I think that's a very good question. So, at the end of the day, let's just understand what a lifestyle business is, okay, versus a corporate business. So the principles for valuing any business are the same. Okay, we've spoken about this in previous episodes. Understand it's a function of risk and reward. What's your cash profitability and how does that grow over time and how certain is that? The other thing we often speak about is a lifestyle business is often very dependent on the owner. So when a business is dependent on an owner and they're very heavily involved in the business, it's difficult to scale that beyond the owner's current capability. So in terms of the value to that owner, okay, to him, it would be very difficult to have taken that value beyond the 270,000. So with a buyer looking in though says, hey, I can replace that owner dependency with systems and processes and people so that this business can scale without me. And so to the seller, that's fair value to him. But to a buyer, because you're going to replace the lifestyle business owner, okay, with, let's call it a manager and systems and processes, it becomes more valuable because you can scale beyond that. So that's the important thing, is the basis of valuing is not different, but the perception of value from the seller and buyer is often very different because the lifestyle business owner isn't able to implement those things. Not that they don't necessarily have the know-how. Yeah, maybe they're quite content for it to be a lifestyle business. So that for me is kind of the biggest thing to understand, is that buyer and seller have different expectations. Owner dependency is one of those. And quite frankly, you might say, well, why didn't the seller demand a higher price if he knew that somebody could do this? Well, that's the part where the deal comes together, right? Is if he could have done it, he would have done it already. He didn't know how to do it. It's the buyer who's bringing that additional value because he's already got the systems and the processes and all of those things. So it sounds like a little bit of circular reasoning, but it's not. And I think that's an important part to consider here.
Yeah, that makes a lot of sense. Thanks for that, Graham. We have a question from Kavika. Is how would you factor in qualitative synergies in overall value, and can this assist with negotiating a higher purchase price? We've been focused very much on the quantitative elements here, haven't we? But are there any other qualitative synergies around that? I'm thinking probably around brand or something. Over to you, Graham.
Yeah, I think there's a few. Yeah, so I'll talk about brand. So one of their criteria was actually around the Trustpilot and the Google reviews. So those were things that they had factored into account in their assessment already. Okay. The other thing, which is, I talk about synergies. The key one in this scenario, was actually the rapport and the trust between the buyer and the seller. Okay, so can you put a number onto it? Very difficult to do, but that was actually key to the success of this, is having trust in each other. In this case, the buyer and the seller actually liked each other. The seller was willing to stay in the business as a director and advisor for 12 years. So I think the fact that the seller or the buyer was willing to share with the seller in some of that upside was really, really important. So, but equally, the seller knew there that he was getting fair price. Okay, so those subtle things in the business around a quick deal, building trust, building rapport, showing that you're not out to pull a quick one over the seller is a fundamental, qualitative factor.
Yeah.
The other things as well, it's not quantitative, but where the business was located, being in the southwest of England as opposed to being in London, just by implication meant that, there was a lower cost base, all of those good things, so it translated into a quantitative metric. But yeah, I mean, there's no right or wrong answer, but it is important. You have to consider them. deal making and doing the right deal is as much about the people and the qualitative stuff as it is about the quantitative stuff. We didn't touch much on that, but there's definitely elements of those in there.
Yeah, absolutely. Thanks, Graham. Yeah, we're both obviously numbers guys, so we're probably lean towards the non-number stuff. But yeah, fascinating. And yeah, I just want to thank everyone for joining us today and for the questions and for engaging and yeah, just listening to us, and hopefully you found it really helpful. We will be following up with the content as well, so you have it to refer back to. And as always, if you want to speak to either me about financial management, reporting, getting investor ready, whatever that may be, please do just reach out to me. Happy to help. And probably for you as well, Graham, at BizVal, if people want any support with any of these topics, I encourage them to reach out to you as well, because you're very knowledgeable and experienced in these matters, and I'm sure you can help them realize more value for their business.
Fantastic, Graham. Thank you as usual, and thanks to everyone who's been listening in. We hope you found it valuable. And as Graham said, reach out to us via email if you've got any questions. We happy to have a 15-minute complimentary chat to see if we can help you, if that's what you need. And yeah, any other follow-up questions, we'll be in touch and can obviously tackle those via email as needed as well.
Wonderful. Thanks so much, Graham. Thanks, everyone. Bye.
Thank you. Ciao.